If the United States ever defaulted on its debt, the shock would not begin on Wall Street. It would begin quietly in the global bond market. The bond market is larger than the stock market. It is the foundation of global finance. Governments, banks, pension funds, insurance companies, and central banks rely on bonds for stability. And at the center of that system sit U.S. Treasury securities. Treasuries are often described as risk-free assets, not because they carry zero risk in theory, but because investors historically trusted the U.S. government to always pay its obligations on time. That trust is what keeps global borrowing costs relatively stable, and that trust is what a default would challenge. First, we need to understand what a default actually means. A sovereign default happens when a government fails to make scheduled interest or principal payments on its debt. In financial terms, it represents a break in contractual obligation. And in bond markets, contracts are everything. If the United States missed a payment, even briefly, investors would reassess risk immediately. Bond yields would likely rise sharply. Bond yields move opposite to bond prices. When investors lose confidence, they sell bonds. When bond prices fall, yields increase. Higher yields reflect higher perceived risk. This rise in yields would not remain isolated to U.S. Treasuries. Global bond markets are interconnected through pricing benchmarks. U.S. Treasury yields are used as reference rates worldwide. Many financial instruments are priced relative to them. If Treasury yields spike, corporate bond yields could rise as well. That would increase borrowing costs for companies globally. Emerging market bonds could face even stronger pressure. Investors often shift capital away from perceived risk during uncertainty. This behavior is sometimes called a flight to safety. But in a U.S. default scenario, the traditional safe asset itself would be under question. That creates a unique complication. If treasuries are no longer viewed as completely safe, investors may diversify into other sovereign bonds. German government bonds issued by the European Central Bank system could see increased demand. Japanese government bonds might also attract attention. However, global markets cannot instantly replace the depth and liquidity of U.S. Treasuries. The U.S. bond market is the largest and most liquid in the world. Liquidity means investors can buy and sell large quantities without dramatically moving prices. That liquidity is essential for financial stability. If liquidity dries up, volatility increases. Volatility introduces uncertainty. Uncertainty increases risk premiums. And higher risk premiums mean higher borrowing costs across the board. Credit rating agencies would likely respond quickly. A downgrade of U.S. sovereign credit would send a strong signal to institutional investors. Some funds are legally required to hold only highly rated securities. A downgrade could force portfolio rebalancing. That rebalancing would create additional selling pressure. More selling pressure would amplify yield increases. Higher U.S. yields would impact global interest rates. Because many loans, mortgages, and corporate credit lines reference benchmark rates linked to treasuries. If borrowing costs rise, economic activity may slow. Businesses may delay expansion. Consumers may reduce spending. Governments may face higher debt servicing costs. The ripple effect spreads quickly in a globalized system. Bond markets transmit financial stress faster than most people realize. There is also the question of derivatives. Trillions of dollars in financial contracts use Treasury securities as collateral. If the perceived safety of that collateral weakens, margin requirements could increase. Financial institutions might need to post additional capital. That sudden demand for liquidity can tighten financial conditions. Tighter conditions can restrict credit availability. Central banks would not remain passive. The Federal Reserve would likely use liquidity tools to stabilize markets. These tools could include open market operations and emergency lending facilities. The goal would be to prevent systemic stress from spreading. Other central banks might coordinate responses. Global cooperation has historically played a role during financial instability. Still, confidence, once shaken, can take time to rebuild. Bond markets operate heavily on perception. Even if payments eventually resume, investors may demand higher yields going forward. That permanently raises the government's borrowing costs. Higher government borrowing costs can influence fiscal policy. Budget priorities may shift. Spending decisions may face tighter constraints. Debt sustainability becomes a more central conversation. Globally, reserve managers would reassess portfolio allocations. Many countries hold significant amounts of U.S. Treasuries as foreign exchange reserves. A default scenario could encourage gradual diversification. Diversification might reduce concentration risk. However, such structural changes unfold slowly. Markets adapt over time. It is important to emphasize that a default scenario is typically viewed by economists as unlikely. Governments have strong incentives to avoid damaging their credit credibility. But exploring the financial mechanics helps us understand how interconnected bond markets truly are. Trust functions as the invisible backbone of sovereign debt markets. Without trust, yields rise. With rising yields, borrowing costs increase. And with higher borrowing costs, economic growth can slow. That chain reaction illustrates why bond markets matter so deeply. They influence mortgages, business loans, pension funds, and international capital flows. They quietly shape everyday financial conditions. A U.S. debt default would therefore not just be a headline event, it would be a structural shock to the global bond ecosystem. Yet markets are adaptive systems. They respond, adjust, and evolve. Financial history shows that policy responses, negotiations, and institutional safeguards often prevent worst-case outcomes. Stability mechanisms exist for a reason. Ultimately, the lesson is not panic. It is awareness. Global bond markets depend on credibility, liquidity, and confidence. And when those elements remain strong, the system functions efficiently. But when confidence weakens, volatility follows. That is the fundamental principle of sovereign debt markets. Understanding that principle allows investors and observers to interpret headlines with greater clarity. Because in finance, perception and trust are as powerful as capital itself. And in the world of bonds, trust is everything.